Good day. Ira Epstein with your financial market wrap-up for this October 2nd, 2019, just after 4:30 p.m. Central Daylight Time. So we started off today, and as you know about the impeachment inquiry, that's going on like there's no tomorrow. And the president, of course, during the course of the day, I saw 2 interviews that he held, and I felt bad for the president. I think it's Finland. To have to go through this, but boy, there's implosions going on. It's terrible. But what really set the stock market off, I think, was 2 things. Number one, we saw the ADP numbers come out, and on ADP, yeah, they had 10,000 more jobs than the trade estimate of 125,000. They got 135. But they revised down August from that whopping 195,000 down some 37 or 38,000 less than that, so that more than offset it. And then we had the New York ISM numbers come out, and they were terrible. They came in at 42 and a fraction. It's one of the worst numbers, and if I read right, it could be one of the worst numbers in like 20 years, 30 years or so. So we're catching up is the fear. The market is fearful that the U.S., which was the last guy standing in the slowdown of everything, is finally succumbing slightly to it. Now, remember, our economy is not built as much as many other economies on exports. We produce, we consume within the United States. Manufacturing, exports, and the like, not the number that you would think it is. So what do we do with it? Well, the break in the stock market is setting things down enough where that 200-day moving average of closes is what you're going to hear on financial TV talk about. You're pulling down the energy markets on this because if the world keeps slowing down, the question is, at what number of supply do you get balanced with everything? Bonds and notes are continuing to see the futures rally, which means real rates are falling. Remember, the recent low was what, around 144 in the 10-year note, or around 160. By the way, I do this all from memory. There's no written boards or anything on that. So where are we? So let's start with this chart, which is our weekly area chart of closes. And as you can see, we've had a series of failures. And when we were up here, we kept talking about the fact that, gee, we're within striking distance, but we're not pushing through it. So now we're getting that correction. We're under the 18-week moving average of closes, which puts the bias to the downside. The last break low in the market on a closing basis was 28.55.5, and we're about 25, 30 points from there, as you can see. When we look at this chart, we see how the market is let go. And the last time we rallied, we were talking that the market was in this old resistance area. And as it turns out, the market couldn't punch through there. So now we're getting people throwing in the towel in the market. You're also hearing talk that, is this a replay of the fourth quarter of 2018, when, if you'll remember, the market started plunging and kept going down? Well, at this point, we're in a downtrend. No getting away from that. You've had the lower highs and lower lows. We've been saying that. The market's under the 18-day average of closes. Let's remove today. Prior to today, the 100-day average could have been one of the support zones. It did not hold. The 200-day moving average of closes, should you extend, comes in at 28.46.5. Now, let's go back if we could here. We're talking a low close of 28.55.5. So there's some reason to believe that maybe there'll be some support in that general area. That's my point. When we look at the Bollinger Band, the market closed sharply under it. The Bollinger Band had also narrowed in as we get through here, as you can see. So breaking down and through it and getting through this support and so on, well, it's a sign that a washout of the longs is taking place. The question is, how deep does the market go? It is oversold. It's the first day under the lower Bollinger Band, or was yesterday? Yesterday's close was 29.37, Bollinger Band 29.50, 2 days in a row under it. It's not excessive yet. So the talk in the town, so to speak, is, will the 200-day moving average zone hold the market up? When we come to the NASDAQ, you've got the same thing. Lower highs. Now you've got another day under. In fact, it's the first day, if I'm correct, under the lower Bollinger Band. The 200-day average is right here at 74.37. You're oversold. You had narrowed in, as you can see, but not dramatic. You didn't have a lot of the sideways action. So I'm going to view this as a market where I think the pros are going to look to see, does the 200-day average hold? That picking bottoms, that's not what I do. It's not what I'd recommend for most traders, in fact. The question is, does the market hold there? But the trend is down. Now, in the Dow futures, the way that they're set up, I don't have 200 days of data in the futures that I can put on there, so I just can't put it. But it's probably close to where these lows came in, because that's how it all fit in before, and that's probably in the 2550 area, 25,500 zone, and we're at 25,985. So maybe another 400 points and you get down there. Wish I had that 200-day average, but I can't create it out of nothing. When we come to the Russell, you've been under the 200-day, the 100, and you've collapsed down. Yesterday we got down and we settled at 1493 and a fraction under the lower Bollinger Band. You're again under it today. But, you know, I don't look for more than a couple of days under it and then for the market to start fighting its way back into those bands. Is that a reason to be bullish? I want to come back there. No. It could be a reason where money comes off the table on the first challenge of the Bollinger Bands. I'm not against that at all, but that's what I think. Now, when we come to the VIX, remember what we were talking about. Writing a call is what I think the pros did, and I said, will they have the power or the wherewithal to want to hang in there? Writing a call is a lot different than when you're at a 12 area, in my opinion, of writing a put. Yes, they're both risky, but you haven't been down to an 8 zone in a very long time. And to get from, let's say, 19, 18 up into the 20s, not a problem. The market's done it on a number of occasions. The question is, you keep your eye on this. You also watch what the futures are doing to see if one's going to lead the other. When this starts breaking down, it's a sign the futures want to rally. They go inverse to each other often. When I look at the bond market, yesterday was the trap day. Remember we were talking, you had this big reversal up, and now the question is, can the market get to the upper Bollinger Band? I don't know. You're overbought. You would have thought with 2 days of this big break in the stock market, you could rally there. Market's having its problems. It's acting like it's tiring at this 1.6. Remember, 1.4 and a fraction was, and I'm talking like 1.44 or so, was the most recent low the market did. It might have even been in the 10-year, the 1.42 zone. And you can see, you went up to the Bollinger Band area today, and you just ran out of gas. 131.08 was our high. 131.09 was the upper Bollinger Band, and this is that area where the market failed last time at the 142, 144 zone when you look at how this converts into real yield. We then come over to TLT. Now this at least has an uptrend. It's got the pattern of higher lows, higher highs, which is more bullish, but it is overbought. It's running. I will say that on all of the futures and the TLT, the ETF here, I'd be watching on the interest rates what these upper Bollinger Bands do. They have a way of containing the market is what I'm getting at, unless a full-fledged panic comes in. In the dollar index, you ran out of your momentum. So people aren't running to the dollar. They've been running actually to the Japanese yen. They ran to the metal markets today. They ran to the bond futures and, of course, the real interest rates. We saw that going on. The eurocurrency got a bounce starting yesterday with the reversal. You can see how the market came back, and today you're following through. You're correcting in present tense, an oversold condition. Resistance is wherever that 18-day average of closes comes in as I'm reading the chart. In the British pound, Boris Johnson today handed over, as I understand it, a plan to the European Union as to what he envisions Brexit to look like. He now has till October 19th to either get a deal done or, according to new British law, he has to ask for an extension. Will he pay attention to the law if the European Union doesn't agree with the plan he presented? In all fairness, I have not seen the plan, so I can't even tell you if it's dead on arrival or if it has anything that's going to go good with it. You've been in a downtrend. You are oversold. You've held twice the lower Bollinger Band. If you get over 120, I think that's 123.82. Let me just check it. It is 123.82. The odds favor that you can get back to that 18-day average and sort of just hang there for a little bit. Japanese yen got back to the 100-day average. Now, I want you to look how that average has suddenly become something of importance. You know, you don't know that they will or won't until you get to them, but on the rally back up, that's where the failure was. Came down to the lower Bollinger Band area, popped through today. Actually, if you come to yesterday, went to that 18-day average, what I call that line in the sand. If you get through it, the next resistance level, you go in steps, you think the market will pay the attention to them, is 93.71.5, then 94.09, let's call it. You can see how the market got up, sort of stalled right against that 100-day average, getting to that upper Bollinger Band. If you follow through tonight, you can be there 1, 2, 3, because that number is going to fall. And what will probably happen is if prices are steady to higher, they'll be on each other. In Bitcoin, you've ended, in my opinion, a bear leg in the market when you had this outside day up. Now, that doesn't mean that the market's suddenly bullish, but I think you ended a bear leg and now the market's looking for new direction. In the spread of Brent versus WTI crude oil, I was on CNBC today talking about this, you know, and I said, who'd have thought September 14th, you get these phenomenal blasts where you take out the Saudi, a big part of a refinery, their oil field, and all of a sudden, instead of the market rocketing up with all that's going on, oil prices went into a state of collapse. The differential, the money was made on the spread differences playing those more than it was this, unless you were smart enough to say, it doesn't matter. Who cares about war and the market's going down? You do realize you've gone from just over $68 a barrel to just shy of $57.50 a barrel right now, all with that taking place. Is it because of too much oil? Is it because of the market getting scared about world demand for oil? I'll let you figure that one out. WTI crude, as far as I'm concerned today, was the day that the pros took money off the table. The first hit of the lower Bollinger Band in an oversold condition. Now, the resistance is showing up here at the combination of the 18 and the 100-day average of closes. If the 18 gets under the 100, some traders will say that's a bearish crossover and that on rallies the market's going to have resistance points there. Gasoline being taken down with the other products. Now, we did see today, we had the EIA numbers come out. They were nowhere near as friendly in the oil as the API yesterday. Yesterday's API was basically, I think, a net 5 million, 5.5 million draw. We had nothing like that. We had basically net zero today. No draws to speak of when you add distillates, gasoline, and the crude together. And the market didn't like that, and it continued on its way down. So we're in that period of time where any supply is too much supply. Last in the net gas. Natural gas. Look at how this market just doesn't let anyone in. This market has had one rally day, and from there, it's just accelerated from this 256 level all the way to 224.5, and it's still accelerating. Now, how many days under the Bollinger Band do we have? Today, yesterday's settlement was under it. That's 2 days in a row. This day's settlement was under it, 233 to 236.5. 3 days in a row, and this day right on it, settled right on the Bollinger Band. So you've got 3 days in a row, gives it a 2% chance, the way that I do my figuring, of the market staying under the Bollinger Band tomorrow, or a 98% probability that the market's going to move to the right-hand side of it. That doesn't mean it's bullish, it just means it moves to the right-hand side of it. I talk about a lot of technicals here, and a lot of you I know love technical indicators, and there's volumes 1 and 2 of Guide to Technical Indicators that covers price charts, chart patterns. As you can see, trend lines, how they're drawn with different patterns traders look at, how you use moving averages, all the different oscillators that we talk about. This was put together with my good friends at Futures Magazine and Modern Trader, and I think you'll find that these articles, the way that they're put together, easy to understand and helpful. So if you'd like to learn more about all this, how do you get it? Well, it's free from us. All you need to do is go to our website. You'll see free offerings. Click on it. Choose the ones that you want. We'll get them out to you by email. And this is a PDF, so you can print it out if you want on your own as well. And you can click up here to get to that page as well. I'm Ira Epstein. For one thing, it's going to be wild. I'll be on Bloomberg tomorrow morning at 9:40 a.m. Hope you look for me there. Take care.